You've done what most people only dream about. You've worked hard, you've saved diligently, and now you're looking ahead, not just to retirement, but to a chapter filled with purpose, freedom, and time to enjoy everything that you've built. But here's the truth. Even with a solid portfolio, retirement income planning isn't just about how much that you've saved. It's about how and when you're going to use your money, how taxes will affect your withdrawals, and how new laws could reshape the strategies you've been counting on. Hi, I'm Justin Haywood, founder of Haywood Wealth Management. We help successful individuals and couples over age 55 create smart, sustainable retirement income strategies so they can live confidently, minimize taxes, and make the most of what they worked so hard to build. And today, I'm going to walk you through some key changes coming with the Secure Act 2.0 in 2025, what they mean for your retirement income plan, and how to take advantage of the new rules without getting overwhelmed. Let's get started. The Secure Act 2.0 was a sweeping update to U.S. retirement laws that's quietly changed the rules for millions of Americans. Whether you're in your late 50s, early 60s, or already retired, these changes will directly impact your income, your taxes, and your legacy. So let's walk through what's changing in 2025 and how to use those updates to your advantage so you can stay one step ahead and build a retirement income plan that actually works for your life. And don't worry, we'll keep things clear, conversational, and free from jargon. Retirement used to be pretty straightforward. You hit your 60s, you start withdrawing from your 401k or pension, add in Social Security, and that was that. But today, it's quite a bit more nuanced. Retirement income planning now involves tax brackets, Medicare premiums, Roth conversions, RMDs, and contribution limits, all of which impact not just how long your money lasts, but how much of it you actually keep. And with Secure Act 2.0, we're seeing big shifts in how and when or must use your money. And this isn't about reacting to fine print. It's about staying ahead with smarter, more flexible income strategies. So let's start with one of the most talked about changes, RMDs, or required minimum distributions. If you have a traditional IRA or 401k, the IRS eventually forces you to start taking money from that account and paying taxes on it. It used to be age 70 and a half, then it moved to 72, but now under Secure Act 2.0, it's age 73, and it's set to rise again to age 75. And while this might seem like a minor shift, it creates a bigger window for smart tax planning. Let's say you retire at 65. That gives you 8 to 10 years before RMDs kick in. And during that time, you can do things like Roth conversions, which is strategically moving money from a pre-tax account to a Roth account. And when done wisely, this can reduce your future tax burden, keep your Medicare premiums lower, and give you more control over your income in retirement. If this kind of tax smart planning is something you want to learn more about, hit the like button and make sure to subscribe to our channel where we cover strategies like this in most of our videos. Next, let's talk about catch-up contributions, because if you're in your early 60s, 2025 brings a big opportunity. Secure 2.0 says that starting in 2025, people ages 60 to 63 can contribute more to their workplace retirement plans, specifically the greater of $10,000 or 150% of the regular catch-up amount, indexed for inflation. But here's the catch. If your income is over $145,000, those dollars must go directly into a Roth account. So you'll pay taxes now, and then the money will grow tax-free and come out tax-free later on. And for higher income earners, this is a smart way to build a tax-free retirement income bucket at the time when you're earning the most and saving the most. Now, here's a new twist that's flying under the radar. 529 to Roth IRA rollovers. Let's say you've set aside money for your child or grandchild's education in a 529 plan and they didn't use it at all for college. Maybe they got a scholarship or chose a less expensive path. Starting in 2024, you can roll up to $35,000 of that unused 529 money into a Roth IRA for the beneficiary. Here are the rules. The 529 must have been open for at least 15 years. The rollover is subject to annual Roth IRA limits, and there's a $35,000 lifetime cap per beneficiary. Now, this is a fantastic way to give your kids or grandkids a head start on retirement without paying penalties and wasting those savings. It's also a smart multi-generational planning move, which is really important to most people. So how do you take action? Here are 4 practical ways to put Secure Act 2.0 to work for your plan. First, reevaluate your RMD strategy. Use the delay to reduce your future tax exposure. Second, maximize Roth opportunities. That includes catch-up contributions, conversions, or both. Third, review your 529 plans. There may be more flexibility than you think. And fourth, coordinate all of your income sources, Social Security, IRAs, brokerage accounts, pensions. They don't live in silos, and a good plan ties them all together. Because at the end of the day, retirement income planning isn't just about this year, it's about the next 20 to 30 years or more. What part of Secure Act 2.0 are you most curious about? Drop your question in the comments below because I'd love to hear what's on your mind to help clarify anything that's still fuzzy. And if you're looking for guidance on how these changes impact your retirement plan, we're here to help. At Haywood Wealth, we work with successful individuals and couples over age 55 to design tax-efficient retirement income plans that actually support the life you've worked so hard to build. Book your free retirement pathfinder analysis today at haywoodwealth.com or give us a call at 281-848-2566. We'll sit down with you, review your income plan, your tax exposure, your goals, and give you a clear, confident path forward. And thank you for joining me today. Until next time, stay smart, stay intentional, and keep enjoying the life you've earned. Hi, my name is Justin Haywood, founder of Haywood Wealth Management. And if you're interested in learning about how we help our clients live their retirement to the fullest, visit us at haywoodwealth.com. Thank you so much.